Iran, the Strait of Hormuz, and the bond market. Flint West reporting. Look, everyone is watching the war. The missiles, the ships, the Strait of Hormuz. And fair enough, that narrow channel carries a huge share of the world's oil. When something goes wrong there, energy prices move almost instantly. But if you really want to understand what this situation means for the global economy, you shouldn't start with the war. You should start with the bond market, because the bond market is where the global economy actually does its thinking. And right now, it's telling us something very specific. Energy prices are climbing, oil is moving higher, inflation expectations are starting to rise. And yet, the 10-year Treasury yield isn't collapsing the way many people would expect if growth were simply slowing. Instead, yields are staying elevated, even rising. Now, why would that happen? Because the bond market isn't just pricing growth, it's pricing inflation. Remember the basic equation that governs the entire fixed income market. Nominal yield equals real yield plus inflation expectations. That's it. When inflation expectations rise, investors demand more yield to compensate for the loss of purchasing power. And that's exactly what we're seeing now. Break-even inflation rates are pushing higher. Real yields remain elevated, so the nominal 10-year yield stays high, even as growth expectations begin to soften. That combination is the bond market's way of telling you something important. The inflation shock is dominating the recession signal, at least for now. And once you understand that, you start to see the bigger macro framework behind it. Because energy shocks behave very differently from normal economic slowdowns. Oil flows into transportation. Transportation flows into production. Production flows into prices. Suddenly, inflation expectations begin creeping higher across the entire system. That's when the bond market changes character. Investors demand higher yields to hold long-term bonds because they're worried inflation will erode those future payments. So yields stay high or rise even while economic growth starts to stall. This is the uncomfortable environment economists call stagflation. And it's not a new idea. Ray Dalio has spent years explaining how markets move through long economic regimes driven by debt cycles, inflation cycles, and geopolitical shifts. In Dalio's framework, the combination of slowing growth and rising inflation expectations marks a transition from a disinflationary regime, where bonds and growth assets thrive, into a more unstable inflationary regime. At the same time, commodity analysts have long argued that energy supply shocks can ignite commodity supercycles, extended periods where resource scarcity pushes raw materials sharply higher. And then there's the work of Zoltan Pozsar, who has argued that geopolitical fragmentation and resource competition are reshaping the global monetary system itself. In Pozsar's view, energy, commodities, and the collateral behind financial systems are becoming more important than ever in determining global capital flows. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Put all of those frameworks together, and something interesting appears. Because when real yields begin to fall globally, capital doesn't just sit still, it moves. When real yields are high, global capital has somewhere safe to live: government bonds. You can park trillions of dollars there and earn a positive real return. But when real yields compress, when that inflation-adjusted return begins to shrink, capital starts looking for somewhere else to go. That's when the bond market stops being the anchor of the financial system, and capital starts escaping. Not randomly, predictably. It flows into assets with duration or scarcity. Duration assets are things whose value lives far in the future: technology companies, innovation, growth stocks. When real yields fall because central banks are easing and inflation is under control, the discount rate drops and future profits become more valuable. That's when growth assets catch a bid. But there's another door: scarcity. Gold, Bitcoin, commodities, hard assets. These don't rely on future cash flows. They rely on limited supply. And when inflation expectations rise, the opportunity cost of holding them falls because bonds stop offering a meaningful real return. So capital moves toward assets that preserve purchasing power. That's the fork in the road. When real yields fall, capital escapes bonds through two doors: duration or scarcity. Which door investors choose depends on inflation. If inflation is contained, duration wins. If inflation is rising, scarcity wins. Now look back at the situation we're in. The Strait of Hormuz is under stress. Energy prices are rising. Inflation expectations are ticking upward. Growth expectations are softening. And central banks are suddenly constrained. Because if inflation expectations rise while growth slows, central banks cannot easily ride to the rescue. They can't cut aggressively. They can't flood the system with liquidity, because doing so risks making the inflation problem worse. That's the trap. And when central banks are trapped, markets start looking elsewhere for protection. Gold, Bitcoin, commodities, scarcity assets. So when people say the Iran conflict is just another geopolitical story, they're missing the real signal. The real signal is happening quietly inside the bond market. Inflation expectations are rising, real yields are under pressure, and the global financial system is beginning to adjust. Not with panic, not yet, but with a shift. Because when inflation expectations climb while growth weakens, the bond market enters a very uncomfortable regime. Yields stay elevated, financial conditions stay tight, and capital begins preparing for a different world. So yes, people are watching the war. But if you want to know where the global economy is actually headed, watch the bond market. Because the bond market is where the real story is unfolding. Flint West signing off.